If you have a traditional IRA and you're between 60 and 73 years old, the federal government has quietly opened a tax window that most retirees will never even know existed, and it slams shut permanently in 2028. This is not a rumor, not a loophole, and not something your financial advisor may have mentioned, but missing it could cost you tens of thousands of dollars in taxes you were never legally required to pay. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. There is a number that the IRS assigned to your retirement account the moment you turned 73, and most retirees never see it coming until it arrives on their doorstep like an unwanted bill. That number is called the required minimum distribution, and under current federal law, once you hit age 73, the government mandates that you withdraw a specific amount from your traditional IRA every single year, whether you need that money or not. The calculation is based on your account balance divided by a life expectancy factor published in the IRS Uniform Lifetime Table. At age 73, that divisor is 26.5. So if you have a traditional IRA worth $500,000, the IRS is requiring you to pull out roughly $18,800 from that account in year one alone. And that withdrawal is not tax-free. Every dollar of it is counted as ordinary income, taxed at whatever federal bracket applies to your total income that year. Now here is where the story gets complicated for millions of Americans who did everything right. They saved diligently. They maxed out their traditional IRAs for decades. They followed the conventional advice to defer taxes now and pay them later. And later has arrived. Because those same retirees are now discovering that pulling required minimum distributions on top of Social Security income and pension income is pushing them into tax brackets they never anticipated. It is raising their Medicare Part B and Part D premiums through a mechanism called IRMAA, the Income-Related Monthly Adjustment Amount. It is making up to 85% of their Social Security benefits taxable, and it is doing all of this automatically, year after year, with no off switch, because the IRS does not care whether you needed the money. The rule requires the withdrawal regardless. This is the financial reality that Margaret faced. She retired at 63 with a traditional IRA she had been building since her mid-30s. Her advisor told her to leave it alone and let it grow, and it did grow. By the time she reached 73, that account had accumulated to the point where her required minimum distribution alone exceeded $9,000 for the year. Combined with her pension and Social Security, her total income crossed an IRMAA threshold she had never heard of. Her Medicare premiums jumped. A larger portion of her Social Security became taxable. Her effective tax burden in retirement ended up higher than it was during several of her working years. Nobody had prepared her for any of it. But here is what changed in 2025 that makes this moment different from any retirement tax planning window that has existed before. On July 4, 2025, President Trump signed into law the One Big Beautiful Bill Act, officially designated as Public Law 119-21. Among its many provisions, this legislation did two things that are directly relevant to anyone holding a traditional IRA right now. First, it made the Tax Cuts and Jobs Act tax brackets permanent, meaning the historically low federal income tax rates that were scheduled to expire after 2025 are now locked in. Second, it created something called the Senior Bonus Deduction, a brand new above-the-line deduction worth up to $6,000 per qualifying individual, or up to $12,000 for married couples filing jointly, available exclusively for tax years 2025 through 2028. After 2028, that deduction disappears entirely. What this means in practical terms is that for a 4-year window, right now, today, through the end of 2028, qualifying retirees have access to a combination of lower tax brackets and an additional deduction that effectively reduces the cost of converting traditional IRA dollars into a Roth IRA. A Roth conversion means you pay the tax on those funds now, at today's rates, and from that point forward, the money grows completely tax-free. No required minimum distributions. No Medicare premium surprises triggered by forced withdrawals. No Social Security torpedo from income that the IRS never needed you to take in the first place. If this is making sense so far, go ahead and hit that like button. It genuinely helps this channel reach more people just like you. Most people who hear about Roth conversions for the first time assume the strategy is straightforward. Move money from a traditional IRA into a Roth IRA, pay some tax, and you're done. And on the surface, that description is accurate enough. But the execution of a Roth conversion during this specific window, with this specific combination of tax law changes, is where the real complexity lives, and where the real danger hides for people who move too fast without understanding what they're triggering. The first trap is the IRMAA cliff, and it is one of the most misunderstood mechanisms in all of retirement tax planning. IRMAA stands for Income-Related Monthly Adjustment Amount, and it is the system Medicare uses to determine whether your Part B and Part D premiums should be higher than the standard rate. The standard Part B premium in 2026 is $185 per month, but if your modified adjusted gross income from 2 years prior crosses certain thresholds, that premium increases, sometimes dramatically. For 2026, the first IRMAA threshold sits at $109,000 for single filers and $218,000 for married couples filing jointly. Cross that line by even $1 and your premium jumps to $259 per month. The next bracket pushes it even higher, and here is the critical detail that most people miss. Medicare uses your income from 2 years ago to calculate your current premium. So a Roth conversion you execute in 2026 will affect your Medicare premiums in 2028. You will not feel the impact immediately, but it will arrive. And if you converted more than your income threshold allowed, you will spend 2 years paying elevated premiums on money you have already been taxed on. The second trap is the Social Security Torpedo, and this one has a name that matches exactly how it feels when it hits. Under IRS Publication 915, the taxability of your Social Security benefits is determined by a figure called provisional income, which is your adjusted gross income plus your tax-exempt interest plus 50% of your Social Security benefits. If your provisional income exceeds $34,000 as a single filer or $44,000 as a married couple filing jointly, up to 85% of your Social Security benefits become taxable. A large Roth conversion executed in a single year without careful income planning can push your provisional income above that threshold and trigger taxation on benefits you may have assumed were protected. The conversion itself becomes an income event, and that income event cascades into a Social Security taxation event, stacking 2 separate tax costs on top of each other in the same tax year. And this is where most people stop reading, stop watching, stop paying attention. But the ones who stay are about to understand something that could completely change how they see their money. The third trap is the Senior Bonus Phase-Out, and it is the most counterintuitive of the three. The Senior Bonus Deduction, introduced by the One Big Beautiful Bill Act, is designed to help retirees, but it was also engineered with a phase-out structure that creates what tax professionals call an effective marginal rate spike. Here is how it works. As your income rises above the phase-out threshold, the deduction begins to shrink. Every additional dollar of income you earn not only gets taxed at your marginal rate, it also reduces your available deduction, which means you are losing tax benefit at the same time you are gaining tax liability. Depending on the size of your conversion and where your income falls relative to the phase-out range, your effective tax rate during that phase-out zone can be meaningfully higher than your stated marginal bracket. A retiree who believes they are in the 22% bracket may discover, after accounting for the deduction phase-out, that the actual cost of their last few $1,000s of conversion income was closer to 28 or 30%. The resolution most retirees are looking for is not a magic number or a single strategy that works identically for every situation. The resolution is a clear-eyed understanding of what questions to ask, what numbers to run, and what order to make decisions in, because the sequence matters just as much as the decision itself. So let's walk through the framework that makes this work. The first step is to establish your current income baseline before any conversion is considered. Pull your most recent tax return and identify your total modified adjusted gross income for the year. This includes wages if you are still working, Social Security benefits, pension income, interest and dividends, and any other reportable income. You need this number because it represents the floor of your income for any year you consider a conversion. Every dollar you convert gets added on top of this floor, and the resulting total is what determines your bracket, your IRMAA exposure, your Social Security taxability, and your Senior Bonus Deduction eligibility. You cannot make a good conversion decision without knowing exactly where you are starting from. The second step is to identify your conversion ceiling for each year of the window. Your conversion ceiling is the maximum dollar amount you can convert in a given tax year without crossing any of the three danger thresholds: the IRMAA cliff, the 85% Social Security taxation level, and the Senior Bonus Deduction phase-out upper limit. For most middle-income retirees, these three thresholds create a target zone that is narrower than it initially appears, but it exists, and converting within that zone is where the real tax efficiency lives. The IRS forms you need to understand are Form 8606, which reports non-deductible IRA contributions and tracks your basis in traditional IRA funds, and Schedule 1A, which is where the Senior Bonus Deduction for tax years 2025 through 2028 is reported. You should also request IRS Publication 590-B, which governs distributions from individual retirement arrangements and contains the Uniform Lifetime Table used to calculate required minimum distributions at each age. The third step is to run a 2-year look-back simulation before you finalize any conversion decision. Because Medicare uses income from 2 years prior to set your current premiums, a conversion you execute in 2026 affects your premiums in 2028, which is the final year of the Senior Bonus Deduction window. If your 2026 conversion pushes your MAGI above the IRMAA threshold, you may enter 2028 already paying elevated Medicare premiums, which reduces the net value of your final year of conversion opportunity. The look-back simulation does not require a financial advisor. It requires a spreadsheet, your current income baseline, and the current IRMAA thresholds published by CMS, which for 2026 begin at $109,000 for single filers and $218,000 for married couples filing jointly. Run the numbers for each of the 4 years in the window: 2025, 2026, 2027, and 2028, and identify the conversion amount that keeps you inside your target zone in each year without triggering cascading costs in the years that follow. I want to be clear. I'm not here to sell you anything. I'm here because this information changed the way I think about money, and I want it to do the same for you. The emotional weight of retirement tax planning is real, and it often gets underestimated. Most people who worked for 30 or 40 years did not spend those years thinking about marginal tax brackets or provisional income thresholds. They thought about showing up, doing their jobs, saving what they could, and trusting that the system would treat them fairly when they finally stopped working. And many of them built genuinely impressive retirement accounts because of that discipline and that trust. The frustration of discovering, at age 72 or 73, that the account you spent a lifetime building is now going to generate mandatory taxable income you never planned for is not a small thing. It feels like the rules changed after you already played the game, and in some ways, they did. But this window, this specific 4-year window created by the combination of permanent TCJA brackets and the new Senior Bonus Deduction, is a real opportunity to respond to those changed rules with a strategic, informed action. Not panic, not guesswork, not a rushed conversion that triggers the very costs you were trying to avoid. A deliberate year-by-year approach that treats each tax year between now and 2028 as a separate opportunity to shift traditional IRA dollars into tax-free Roth territory at the lowest effective cost available under current law. The retirees who will look back on this window with confidence are the ones who took the time to understand what it actually offered, ran their own numbers honestly, and made deliberate decisions in each of the 4 years it remained open. The ones who will look back with regret are the ones who heard about it, meant to act, and watched 2028 arrive without having done anything at all. You now have the framework. You have the thresholds. You have the form numbers. You understand the 3 traps that can turn a good strategy into an expensive mistake. What you do with this information is entirely up to you, But you now have no reason to be unprepared. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early.